Thanks for making it to Veterans Info Tap. I'm glad you made it today. Today I wanted to talk to you about a benefit that some of us use, some of us don't, and wanted to shine a little light on it to let you know the power of this specific benefit and how you can then leverage $1 million, hundreds of thousands of dollars of other people's money for your benefit. So please hit the thumbs up for me, subscribe, share with a friend, all that good stuff, because it helps get this information into the hands of those that need it, even if this is something that you already know about. So if you didn't guess already, it's the VA home loan. Now, it's not that the VA is actually lending you money. What it is it's really the VA going out to lenders like Chase Bank or Navy Federal Credit Union or Pentagon Federal Credit Union, which I highly recommend, actually both of those. But for a mortgage, Pentagon Federal Credit Union did a fantastic job for me, and I was very picky with the institution that I went with. So with the VA loan, what happens is the VA essentially guarantees the loan to limit risk for the lender. Therefore, the lender is able to do a few things for you as the borrower. Now, again, this is about buying a house, right? So a mortgage allows you to buy a house using somebody else's money, right? So you're getting a loan. The difference between getting a mortgage or, say, a car loan, right? One is you are getting a car loan for a liability. A car is a liability, at least 99.99% of the time, right? No, probably nobody on here is buying a car that's actually an asset. So what we're looking at is liability is a car loan, and your mortgage on a home is an asset. And over time, yes, the market's cyclical, it goes up and down, but typically the longer you plan on holding that asset, a home, the more likely you are to increase in value. Now, depending on your age and your situation and all that stuff factors in different kind of mindsets and different things. But it's important to really open up your mind to the different possibilities that there are. One of the big changes to the VA loan that I'm really a fan of, and I'm happy that they did it. And just for disclosure, I was in mortgage banking for about 12 years. So I ran a team for a mortgage company. I was a co-owner on a mortgage brokerage. So I understand mortgages, and I did it for 12 years. So with VA loans, there used to be a cap to the loan limit. Okay, not the purchase price, but the loan limit. And the difference is, for example, let's say that loan limit used to be $400,000, right? And you wanted to buy a house that was $500,000. You could still do a VA loan, but you got to make up that difference of $100,000. So not ideal. So that about maybe 2-3 years ago, they removed the limit to VA loan. So now simply, if you're able to qualify based on your debt to income ratio, meaning the total number of debts, including your new mortgage and taxes, insurance, all that stuff, that total outgoing that you have divided by your total gross income, which that's why it's important to gross up your VA compensation, your total gross, that the rule of thumb is around 45%, but you can always go a little higher than that if you have some compensating factors and so forth. So the idea here now is that you could go buy whatever you qualify for. If you qualify for $1 million home, then go buy $1 million home, right? So it opens it up for the lenders to be able to loan these higher loan amounts. Now remember, a VA loan is a 100% loan, so you're not coming out of pocket with anything except for your closing costs. Now, with closing costs, you could request the seller to pay your closing costs for you, so then you're truly coming in with no money out of pocket because your loan is 100% funded and your closing costs are being taken care of by the seller. A typical way that this would work would be, let's say, just for easy numbers, you saw a $500,000 house, they were asking $500,000 for it, and you said, hey, look, instead of $5,000, I'll give you $508,000, and if you could pay my closing costs with that $8,000. And then let's say that the total was $10,000 in closing costs, but you got a $2,000 credit coming back from the lender, something like that, to equal that 10 to make sure that all that gets taken care of for you. So that's one scenario in which you can really truly get into a $500,000 property in this example and leverage that $500,000 for growth, right? Where else can you say, hey, can I borrow $500,000, $500,000, and oh, by the way, can I keep all the interest that I earn in growth from that $500 investment? In other words, if my $500,000 house increased over a 10-year period to $700,000, now I get $200,000 of growth there that's mine, right? That I now own that equity in the home. That is huge. Now, in addition to that, not only do you get that growth that you get to keep, you're also making payments on that home, of which we're going to have to pay to live somewhere, either rent or buy. So if you're buying, now you're making payments toward the mortgage. That $500,000, if you have for example, a 30-year fixed loan, will slowly over time reduce the principal amount that you owe. In other words, your $500,000 over 10 years might be whatever, $380,000 in 10 years, right? So it's slowly going to go down. It's kind of a weird curve. You pay off a little bit of principal up front, and over time you pay more and more, right, toward the principal. So the last few years you're paying mostly principal in your payments, and the first few years you're paying very little. So it's kind of a sliding scale. Another thing, though, to consider, not only are you paying down the amount that you owe, which subsequently increases your equity, you also have tax write-offs that come with that. You get to write off the interest and real estate tax of that specific investment that you have. So not only did you borrow $500,000 in this example to be able to purchase an asset that you get to keep anything that it increases on, right? So any value that it increases, you get to keep. You're not penalized if it goes the other way for a minute. And you can make payments back on that loan that creates more equity for you. And you also have a tax deduction that you can use for the interest and the taxes on that. And on top of that, if you sold that property, if it was your owner-occupied home and you lived in it for, say, 10 years and you decide to sell it, you can walk away without paying capital gains. And if my memory serves me right, and I could be wrong, and I'm not a financial advisor or tax professional or any of those things, so you'd have to go check. But the last I remember, as a single person, you can go up to $250,000 gain if you've lived in that home 2 years of the past 5 and not pay any capital gains on there, as long as you've lived in it 2 years in the past 5 years as your owner-occupied residence. If you're married, that number doubles, so you'd have $500,000 worth of equity that you can gain in that home in a positive way and not have to pay any capital gains, which is fantastic. So what are some of the other benefits, right? Another benefit about this loan versus other loans is that even though it's at 100% of the value of the home that you're purchasing, you do not have to pay what's called PMI, private mortgage insurance. So most lenders will, actually they all will, if you have over an 80% value on your loan, so if your one loan is 90%, or you have one loan at 95, or you have one loan at 100%, or somewhere in that range, you will be required to pay private mortgage insurance, just another way to save the bank in case something went south with you as the borrower. So you don't have to pay this with a VA loan, which is fantastic. Essentially, the VA is paying it for you for the bank, limiting their risk exposure. Another thing to consider is that it has limited closing costs compared to other mortgages. So there's some fees that just can't be charged. So in the event that you were to pay all of your closing costs, there are some dialed down features in that, so you're not being overcharged, which is also a good thing. The rates are competitive. Like I said, shop around. I found my best rate with Pentagon Federal Credit Union. And then lastly, if you are a disabled veteran, they waive the VA funding fee. The VA funding fee is 1% of the loan amount typically, so you're looking at a $500,000 loan, you're looking at a $5,000 funding fee. Substantial. Waived if you're a disabled veteran at any percentage. So if you are not currently rated, what you do is you file your intent to file today before you buy your house. If you end up getting approved for your service-connected condition, they will make the effective date the date of that intent to file. Then you can ask for a refund of that funding fee. So that's an important little workaround there for those that are not aware. So with that, just wanted to shed a little light on the VA loan process and some of the advantages to it. Happy to share the information. And remember, if we don't take care of each other, something went wrong. Have a great one.